Hello and welcome to another in our series of A3 Management Consulting Energy webinars. Today we're going to be talking about Central, Southern, Eastern Europe. Quite a few countries, as you can see, a focus on Hungary, Romania, Ukraine and Serbia. And we have some excellent presenters who are deep in knowledge of what's going on. So thank you. If we skip through onto the presenters. So I'm Matt Brown. I am Vice President in the Management Consulting Division, and I will hand it over to one of the Philipps to introduce themselves.
Thank you very much, Matt, and welcome everyone to the webinar today on Central Southeastern Europe. I'm Philipp Gueorguiev. I'm a senior principal here in Vienna, and I'm leading the A3 market modeling activities across Central and Southeastern Europe. And in more recent years, together with our team in Vienna, we are expanding further into countries with developing power markets, including Ukraine, Georgia, Kazakhstan, Azerbaijan, and others across the new Silk Road markets right up to China. And it's a pleasure to hand over to my colleague, Philipp Ortmann, to also make a brief introduction.
Yeah, thank you, Philip, and welcome everyone from my side. My name is Philipp Ortmann. I work as a consultant in the Vienna management consulting team, and I mainly deal with electricity market modeling topics ranging from all kinds of renewables over imbalance costs and also some climate change modeling topics as we covered them last year. Yeah, I'm looking forward to the webinar today. And over to Yana, please.
Thank you very much, Philip, and a warm welcome from my side as well. My name is Yana Andrushko, and I'm analyst in the Vienna team as well, focusing on the electricity markets across the Central Southeast Europe, as well as the markets along the New Silk Road, and currently also focusing on the renewables topics within these countries. Thank you, and looking forward to the webinar.
Excellent, thanks all. So if we pop to the next slide, I'll just run through some housekeeping. Just to say, we will take questions throughout in the little question area you can find on the GoToWebinar panel. So please do ask questions as we go along. We have an hour today for the webinar. So we're going to present some material and then have a bit of a discussion at the end and pick up some of those questions. The slide pack and recording will be made available to everyone, so don't worry about taking notes. You'll get the material later on. And just to say, you can find our back catalogue of webinars if you are to search on your internet browser for A3 Management Consulting Energy Webinar. I think you'll find the page very easily, and we've got a very interesting back catalogue of webinars covering all manner of subjects, ranging from sort of market analysis we're talking about here through operational strategy and transaction topics as well. So please do take a look. I think that's probably covered everything. I'll be back to help with the Q&A later on, and with that I will hand it over to Philip to take us through the style of the material. Thank you.
Thank you, Matt, and I see that a few more attendees have just joined the webinar, so warm welcome once again to everyone to the Central and Southeast Europe webinar today. Despite an ongoing challenging backdrop, right now Central Southeastern European energy markets have recovered in recent months, especially since the end of last summer, with their power price levels especially, and are still rapidly transforming due to market and regulatory drivers. And this transition presents both challenges and opportunities, especially for new renewables built on the path to further reduce carbon emissions, which is the target long-term for their power systems. A3 covers, as we outlined a moment ago, all the countries in Eastern Europe, and we now model also additional markets right up to China for example, including Ukraine, Georgia, Kazakhstan, Azerbaijan, Uzbekistan, Russia, and for many years also Turkey and all the countries in these regions. We see key drivers of change in value being the European Union emissions trading carbon pricing scheme, this is presently, as you've most likely seen, at all-time highs, despite a very likely long-term a long system for last year due to a drop in emissions caused by the pandemic. And allowances for 2020 carbon emissions have to be surrendered by the compliance deadline tomorrow for 2020. And it'll be quite an interesting result to see the final numbers in the coming days. But to achieve further decarbonisation in Europe and beyond the respective timeline now and the initiatives in the EU, the European Commission is looking at further ways to stop carbon leakage from outside of the EU and is pricing also certain non-ETS sectors. For example, this includes a strong push for renewable targets outside the EU and possibly carbon border tax for imports, especially for jurisdictions that currently have no carbon charging schemes. And new sectors in the EU will face carbon charging mechanisms, such as initiatives in Germany with carbon pricing for transport and building sectors in particular, which I'll revisit in a few slides. A key regulatory further theme is now on the topic of renewables, the pan-European harmonization of cross-border electricity balancing and the sharing of reserves, partly thanks to more efficient interconnection utilization, which is also in the target of the EU and Energy Community, the supranational body that basically ensures that the EU's energy acquis is transposed and implemented in the non-EU countries and contracting parties that it has, such as Serbia that we cover today, Ukraine, and for example, the non-EU Western Balkan countries. All of this will also lead to further cost optimization and mitigation for renewable imbalance costs, and that will be driven both by market and regulatory drivers, which we'll briefly revisit during these slides today. On the upside for renewable energy, we see an increasing number of corporate and otherwise also offtake of PPA opportunities, and their potential in Central Southeastern Europe is now emerging. Although this might take a few more years, maybe 2-3 years before it fully takes off and there are more concrete opportunities. We see that there are increasing number of commercial developments and opportunities, and this is one of the major inquiries we're getting these days from our clients. On the right-hand side here on the slide, you see a few snapshots of key developments in the core countries that we look at today. In Romania, for example, it saw since last summer legislative changes that would enable the country to again have in place PPAs, this is something that will certainly enable further renewables growth after the GC scheme is likely to be superseded also by contract for differences. And this is a framework that is presently under review with the national regulator ANRE and EBRD. In Ukraine, there has been a recent green energy boom, and the country has also partly faced challenges around the renewable support scheme and its funding. But some of these are being also legislated and further regulated, so that uncertainty is likely to ease off to a certain degree, and Ukraine's planned entry synchronization of its mainland system with Bushtin Island around the mid-2020s as presently planned, and we model it that way as well, together with its interconnection with ENTSO-E power grids in Poland, Slovakia, Hungary, and Romania, will create more opportunities also for exporting surplus electricity, and it will also strongly contribute to the country's security of supply once it disconnects from its current operation with Russia and Belarus and integrates further into ENTSO-E grids. Hungary has a strong path to more solar PV investments, and this is also planned in its National Energy and Climate Plan 2030, and based currently on the auctions, which we'll also revisit in a few slides. AFRY has seen a strong push and surge in such advisory projects and certainly investments to follow, especially for solar PV in the country. On the other hand, given that mainly fossil fuel generation and especially gas-fired generation is currently providing power in the balancing market. There are no major baseloads, and the country also has no major baseload hydro generation. Hungary still presently has relatively high imbalance costs, and so these are set partly to fall due to market design changes and possible mitigation measures, which we'll revisit towards the end of the presentation today. Serbia has the highest carbon intensity presently from all the 4 markets that we presently have prepared for this webinar today to review, and that certainly will impact its power price once the country implements a carbon charging mechanism, which is likely to be implemented through the energy community, of which the country is a contracting party. And certainly a carbon charging mechanism in Serbia or in the non-EU contracting parties of the energy community will lead, on one hand, to higher power prices, but also it will reduce their relatively high presently carbon footprint. And the auction support system, which now in its draft version is still being reviewed in Serbia, there is a strong expectation that the Serbian renewables market will pick up again, and we have quite a few opportunities lately again on onshore wind developments in the country. Thank you.
Now, let's have a deep dive into the markets under review and see how they're progressing towards their renewables targets. And of course, it's worth mentioning that the targets vary by market depending on the current progress, as well as ongoing regulatory changes in the renewable energy sector. Now, as you see, Romania and Hungary, the countries that are the European Union members, they were obliged to submit their national energy climate plans with the set targets for 2030. And initially, Romania set a target that was far below the national potential of renewable development in the country, while it was also below the collective EU target of 32%. In this respect, the European Commission recommended Romania to increase its target to at least 34% in 2030. However, the country currently set the set target for 30.7% only. Well, with regard to Hungary, the National Energy and Climate Plan was also approved by the European Commission, and it states the aim of reaching a 21% share of renewable energy sources within the gross final energy consumption by 2030, and it's again significantly lower than the EU's binding 2030 target of 32%. In Hungary, nuclear power is and will remain a significant player in the energy strategy of the country, and in fact, Hungary is planning to commission 2 nuclear power units at PAX-2 until 2030. Besides, the plan heavily relies on the expansion of domestic solar capacity. The Hungary foresees around 10-fold increase of the current solar capacity by 2030, while the development of wind power remains subordinate to solar in the energy strategy of the country. Now, compared to Romania and Hungary, Ukraine and Serbia, presented on the next slide, are not the EU members, and therefore they're not legally bound to develop a national energy and climate plan. While being contracting parties of the energy community, the countries committed to submit these plans. However, the plans are still pending. According to the National Renewable Energy Action Plan, which sets the targets for 2020, Ukraine has a target of 11% share of renewable energy sources in its gross final energy consumption. And despite the binding nature of the target, progress towards the goal until 2018 has been rather slow. Nevertheless, Ukraine saw a significant increase in its renewable energy capacities, in particular in 2019, and thus has been increasing the contribution of renewable energy sources to its final energy consumption, making the 11% goal quite achievable in 2020. Serbia's progress towards renewable targets has been also slow, and there has been little progress in transport sector, in heating and cooling sector, while renewables in electricity are only high due to hydropower plants development, while there is still insignificant capacity in solar PV and wind in the country. Now, of course, countries will need massive investments in the coming years in order to help in the transition to clean energy, as well as to meeting their renewables targets. And therefore, currently, the governments are considering and developing the support schemes, moving away from feed-in tariff and to more attractive and competitive market-based support schemes like auctions. And this is something that is in common for all of the 4 markets presented. For example, Romania has the green certificate support scheme, which envisages that producers receive green certificates per megawatt hour of power generated. However, this scheme has been closed to capacity additions since already the end of 2016, and therefore only previously accredited capacity continues to receive certificates. Now, the country is moving towards the contract for difference scheme, which is currently under development by the Ministry of Energy together with EBRD. And although there are no official timelines published on when the scheme will be introduced, it is well known that this will be focused on the renewables as well as nuclear and in general clean technologies. Now, Ukraine is also benefiting and has been benefiting from quite a generous feed-in tariff scheme for renewables, and the growth of solar and wind capacities in 2018 and 19 was rather attributed to this factor. However, this significant increase has become a challenge for both market mechanisms, the power system, to balance fluctuating renewable generation, and therefore huge payment debts to renewable generators have gathered and were not compensated since the early 2020. To prevent this crisis in the renewable energy sector, the government and the investors agreed to feed-in tariff restructuring with the subsequent law issued in August 2020, which decreased the amount of tariffs applicable to both wind and solar technologies. And this is done through some reduction factors. Now, Ukraine is also moving towards renewable auctions, and these are finally to be held starting from this summer, and on a looking forward basis, while the procedure is still not existent and not known. Hungary is also benefiting from both feed-in tariffs and feed-in premiums, which exist. However, only feed-in premiums are currently available for new projects. And it's worth mentioning that, of course, producers receive a certain limit, and there is a certain limit of support provided by the government each year. So therefore, Hungary is also moving towards rather market-based support schemes. Serbia has, on the one hand, exhausted its feed-in tariffs already for several years, and this system was abandoned in 2020. However, it's been doing great effort and already has made several steps towards introducing auction systems. As already mentioned, the current draft law is under consultation and approval by the parliament, and the country is expecting to introduce auctions towards the end of 2021, beginning of 2022.
It is very important that for the bankability of projects, there are certain support schemes, and that is the regulated framework or frameworks that have been common pretty much in the last decade and a bit since the renewable targets have been introduced also across Europe and especially for the EU. However, the latest trend is that there is a move away from the high levels of some of the feed-in tariffs in the past, or green certificates also in some of the markets in Eastern Europe, where applicable, for example, in Romania, partly also in Poland. And now this current status is to move towards a more market-based mechanisms, and price signals from the day-ahead market, for example, is a strong also determinant of what on a merchant run basis, and hence the merchant renewables risk for green energy projects would mean. And that's why on this slide we are presenting essentially the effect of so-called onshore wind revenue cannibalization, which can also be a driver for power prices in markets with high wind generation, such as, and possibly in some periods concurrently, very high solar PV generation, such as in Germany, where also negative prices have been frequently seen in many hours in recent years. And this negative prices phenomena is not an issue yet for Eastern Europe, and this is not coming to most of the markets that, or any of the markets that we cover today. But certainly, on the other hand, in this illustrative example with the chart on the left-hand side here, you see the capture rates for onshore wind as an example from Romania. And the chart with the solid blue line essentially represents the average capture rates across 5 historical years as we model them at AFRY for a specific forward scenario. And the gray, the shaded area, showcases the potential weather-related volatility. And this is important when, depending on the wind resource availability in specific years, essentially to stress test your financial models if within the range from minimum and maximum capture rates, as opposed to essentially this is the capture rate is the capture price divided by the baseload price. So at times of and high correlation in output between renewable generators in a particular market, to what degree would the capture rate drop below the baseload price, and that is a strong indicator essentially for the also bankability potentially of renewable projects, and what is the merchant renewables risk in this case. And partly similar analysis can also be done and is feasible for solar PV assets. And this is essentially a product and an analysis that many of our clients looking at renewables nowadays are requesting from AFRY to analyze. And weather-related volatility certainly can influence within the year on a seasonal basis, on an hourly basis, but also over many years, the returns of renewable assets. Now, talking about a moment ago about the carbon pricing and EU ETS, the EU is obviously planning to upgrade and to essentially have even stronger and more ambitious climate initiatives, and these are embedded in its both European Green Deal and more recently the European Climate Law, which the more ambitious proposal for aiming at a reduction of minus 55% of carbon emissions in 2030 as compared to 1990 was voted into law pretty much last week, and that is a package that the EU with further initiatives will look at also combining with measures to prevent carbon leakage through having for example, carbon tax for imports at the border for countries where no carbon charging schemes are present currently in place. And the EU aspires also to be climate neutral by 2050, with its economy sectors having net zero greenhouse gas emissions, as is the current plan from the initial climate law, and this is further to be legislated upon in the coming weeks and months and probably years. The positive thing so far has been that the EU has met and achieved its 2020 decarbonisation target by overachieving a minus 20% reduction relative to 1990 levels for its carbon emissions. But this is pretty much only the beginning, and now the path to further decarbonisation is probably going to include even more costly carbon abatement technologies, and those investments will need to be made. And on top of that, on the top right hand side diagram, you see an outline of the European Commission's present expansion plans for further introducing carbon pricing to new sectors that are currently not included in the European Union's emissions trading scheme. For example, in Germany, from January this year, transport and building sectors, as I mentioned briefly in the introduction, will see additional carbon taxing and carbon taxes to incentivize further decarbonization, as related to, for example, petrol, diesel, or heating oil prices. And those sectors are likely to be seeing similar charging schemes for carbon emissions across the EU. Other sectors that are outlined here will also be seeing further measures in bringing them under an umbrella of carbon charging, and this is currently being further assessed by the European Commission as to how to further proceed. And there will need to be some sort of a uniform carbon pricing for all energy sectors and additional non-ETS sectors to be involved in terms of a further decarbonization path. The bottom right pane essentially exemplifies that not all candidate sectors for this segments can be fully and immediately integrated into either the EU ETS or other carbon charging frameworks, either due to partly political or also partly economic factors. And the most likely forward scenario will combine and comprise both a certain carbon pricing scheme plus some regulatory initiatives, including very likely energy efficiency and renewable energy targets, certain development loans, and additional incentives. The legislative process is still ongoing, and would welcome all our clients to share their views with AFRY how these further decarbonization initiatives may impact their businesses as well. On the topic of carbon pricing, new regions for the European Union's emissions trading scheme might be emerging, and at the moment, Ukraine has a partial carbon pricing scheme in place, essentially for thermal power plants such as CHPs being impacted. And Serbia is yet to adopt such a regulatory carbon charging framework, especially in the near future. And this carbon pricing framework is a powerful element of the EU's decarbonization agenda, and the energy community as a supranational body with responsibility for its contracting parties will need to introduce a framework thereon that is similar to other EU directives which already have been transposed or implemented in the said countries, including the Large Combustion Plant Directive, the Industrial Emissions Directive, and other similar environmental based directives impacting power generation. Managing carbon emissions through a carbon pricing scheme can also be a clear signal to investors into renewables capacity. And in particular, strong carbon price or high carbon prices can also support electricity prices across the region. And this is what we're seeing already year to date with many countries in Central Southeastern Europe recording a range of 55 up to 60 euros per megawatt hour year to date on the day-ahead power exchanges prices, euros per megawatt hour. And those prices are already a signal that despite the corona backdrop at the moment, with a strong carbon element and recovery in demand, power prices can be also staying at a relatively high level. In this respect, the two countries we focus in this on this slide, Serbia and Ukraine, as well as many of the other non-EU Western Balkan states, at the moment have a relatively old and less efficient fossil fuel fired power generation, and many of them are still required. Many of these units are still required for preserving the security of electricity supply with an adequate generation level. And there are, on the other hand, some local subsidy policies for such coal and lignite, for example, mining in these countries, as well as there are clearly socioeconomic and political implications given the related jobs and energy independence effects, which will also need to be carefully thought through by policymakers and will need more transition time to properly manage. Additionally, power exports from the said contracting parties, so non-EU contracting parties as within the energy community, and when they export power into the EU, this can lead to carbon leakage. Thus, the carbon pricing framework will correct for some of these distortions and negative externalities. In principle, more cross-border exchange and market integration can also smooth the process of introducing a carbon charging mechanism. And this is the intention of the energy community as well, to have a holistic regional approach. And this process is right now ongoing. We're also in contact with the energy community on some of these initiatives. And this has also concurrently been supported by an independent advisor on setting up a feasible and relevant carbon charging framework. And we in AFRY, we have our own, since many years, carbon pass-through assumptions for Ukraine, Serbia, also North Macedonia, Montenegro, and other non-EU East European countries. And we have been foreseeing this trend for quite a while now.
Let us continue with a quick snapshot of historical electricity prices in the 4 countries. So what we have here is an overview on the day-ahead prices the past 4 years for Ukraine, Hungary, Romania, and Serbia. A couple of things are striking. First of all, there's quite some movement on the markets, so lots of up and downs, which are mainly driven by weather-related factors. In particular, the spike in early 2017 was triggered by a cold weather spell, as well as some export bans in this region. Partly, it is also driven by fuel price volatility, in particular for the carbon price, as discussed by Philipp. Yeah, and Ukraine, for example, is a little bit of an outlier on this chart. Why is that? This is mainly a reason related to the fact that the exchange is not very liquid at the moment, so the traded volume is rather low in Ukraine, and prices do not move as freely as in other markets, or as they could in theory. For the future, we're going to expect some more convergence with regards to Ukraine. So it will align a little bit closer to the other markets. There's liquidity and volumes going to increase. And yeah, in general, we expect some convergence in the next couple of years, but in the long term, there may also be some diverging elements when some countries drift away with their fuel prices, but also the capacity mix that is a little bit uncertain how it will evolve in the future in those countries.
Now, of course, given the ongoing regulatory changes in all of the markets, renewables development faces a number of both opportunities and risks, which are important to consider and of which we need to be aware of. And let's look into those for each of the markets separately. For example, in Romania, although the green certificate scheme is still and will be applicable to already existing renewables plants, newly commissioned projects will no longer receive this type of support, and therefore they are most likely to benefit from the recently reintroduced power purchase agreements, which were, by the way, banned in Romania from 2012, while also the contract for difference support mechanism that is currently under development. While the power purchase agreements are already in place, the uncertainty around the CFD scheme still exists, in particular on the date of its availability, as no official timelines have been announced yet. Besides, in Romania, renewables have priority access to the grid, while it will be important for renewable developers to further see and decide on the potential project's location. The reason for this is that currently the legislation in Romania forbids all Romanian and foreign citizens who have not been farmers active in Romania for the last 5 years from buying any agricultural land, and this creates a major obstacle to new capacity build. In Ukraine, as we've already mentioned, there is the situation with unpaid debts to renewable generators under the feed-in tariff, which triggered sort of an unstable situation in the renewable sector. And although the investors and the government agreed to feed-in tariff restructuring for both wind and solar technologies through some reduction factors, the feed-in tariff support scheme will no longer be eligible to new installations. Instead, the auctions that are finally to be held starting from July 2021 are under development in terms of procedure and auctions, but there is still no legal outline, and therefore that creates sort of an uncertainty around those auctions. At the same time, further strengths in Ukraine are, of course, the ongoing synchronization of the Ukrainian power system with CSEE, the likely introduction of the carbon pricing mechanism in the country, which will further trigger deployment of renewables in the country, while the country clearly moves to being carbon neutral. Furthermore, renewable developers are further incentivized to build renewable capacities in Ukraine, and this is due to the fact that they may receive certain subsidies for using the Ukrainian equipment, for example. Now, Hungary, with its wholesale electricity market, which is characterized by high liquidity, shows quite significant volumes of electricity traded on the day-ahead market and intraday markets, and this allows also to build new renewables capacities on a merchant basis. While probably the most important recent change in the renewable sector was still the introduction of the METAR support system, which applied to generation of electricity from renewables starting from 2019. And this offers both mandatory feed-in tariffs and premium subsidies to power generation units. And worth mentioning, however, that only feed-in premium is available for new projects. One important thing to mention also about the Hungarian market is that at the end of 2016, the government is sort of controlling the wind new build, and this is due to the restrictive changes to the legislation on restrictions to construct any new wind farms. The current regulatory environment for now makes it close to impossible to obtain any new wind park licenses, and of course there is a question as to whether Hungary strategically sees any role in wind in the energy mix over the next 10 years. With regard to Serbia, probably this is the country which was the first contracting party to have an operational organized wholesale market, but the liquidity is rather low. And this is also mirrored in the ongoing changes to the legislation, and Serbia is trying to, of course, deploy more renewables. However, a certain support scheme, attractive support scheme, is needed for this purpose. And as we've already mentioned, the feed-in tariff subsidy scheme has been fully exhausted for some years in Serbia, and therefore the country is gradually transitioning to competitive auctions. And on the bright side, of course, the Ministry of Energy is currently in the process with EBRD to transition to competitive auctions, and they're developing them, and likely they will be implemented by 2022.
Speaking of risks and challenges in the region, we need to cover, or we need to talk about imbalance costs as well. Imbalance costs in these markets are definitely a challenge and a certain risk. Starting from a rather physical point of view, it is interesting to do a quick deep dive on where do imbalance costs actually come from. Obviously, it is related to the fact that supply and demand is out of balance at some point in time, and frequency is kind of out of control and deviating from 50 hertz. This leads then to an action by the TSO, which needs to bring demand and supply back into balance again, and calls up upon ancillary services to rebalance the situation again. And in the end, this leads then to costs for downwards regulation on one hand, if power plants need to ramp down and reduce their supply a little bit. Or on the other hand, it could lead to costs for upwards regulation. So for costs for power plants to increase their power supply. And these two blocks form the basis for the imbalance costs, actually, which are related to the physical balancing prices. So the imbalance prices are usually a weighted average of the physical balancing costs that arise on the system. Continuing then with the imbalance settlement, there are different ways how countries treat these costs, these physical costs, to stabilize the system. Most countries in this region have the so-called dual cash-out system in place, where we have two imbalance prices per time period, meaning that there are different prices for buying and selling energy. So typically you will get a different price when you are short, typically a higher price, than when you are long, which is typically a lower price for surplus energy, which is actually quite uncommon, at least in economics, to have two different prices for actually the same good. A different scheme is the so-called single cash-out system, which is, for example, implemented in Serbia and also other Central European countries like Austria and Germany here on the map, but also Spain, for example. Here the prices for buying and selling are the same, but it leads to a different complication, namely that as a renewables producer, you typically correlated to the entire market wind arrow, for example. And this leads to a so-called stochastic problem, as you'll be always actually, or most of the time, on the wrong side of the curve and buying for high prices and selling for low prices. The right-hand side, we have some drivers for imbalance costs. Most importantly, increasing wind and solar penetration in these countries will drive imbalance costs up, exactly for this reason, for this stochastic problem, that you as an individual producer are somehow correlated to the entire system area. And with increasing renewables penetration, this makes the situation a little bit worse. In addition, we have problems such as rising the head or commodity prices. This will, especially in a dual cash-out system, this will lead to an increasing gap between deficit and surplus prices, which leaves you with a higher cost position. Typically, in single cash-out systems, the prices are lower as you get rid of this systematic problem that the prices differ for deficit and surplus. To give you a brief overview, what is the level of current imbalance costs? It's quite a challenge actually in these countries, in these markets. For onshore wind, for example, where imbalance costs in Germany or Austria are rather low, so in the single digits or low single digits per megawatt hour. In the markets, in particular in Hungary, for example, but also Romania, Serbia, and Bulgaria, it may go towards double digits, so close to the 10 euros actually. Same is true for solar PV, where in particular for Hungary, for example, with high solar and also rising solar PV penetration, costs are going to increase over time as the stochastic problem, so the correlation to the entire system area, is likely to increase over time. A couple of points on how this might be mitigated. It might be expected that the individual forecast error might decrease over time. It is also likely that geographical diversification is going to increase and spread out across the country, which also decreases the forecast error. And also there might be some relief from balancing groups and liquid intraday markets, which lead to kind of a lower cost position.
Thank you, team. And just if we have a couple of minutes for final concluding remarks on the webinar today before we go into the Q&A session. Central Southeast European power markets are accelerating the pace of decarbonisation, and this is partly driven by regulatory and policy and legislative steps, but also by market drivers and price drivers. And the opportunity for further renewables will also be based around further incentives, either with new schemes, support schemes that we reviewed today, or based on further decarbonisation trends and carbon pricing schemes, or purely on a merchant renewables basis. And just for example, the power systems of Ukraine and Serbia have an approximately 2 times higher carbon intensity than Hungary and Romania. So those two markets, as they're getting closer to the EU, they will need to also further with the EU further integration potentially one day. They will need to continue this decarbonisation path with even additional investments into renewables, and that could be also on a merchant renewables basis. And that risk, that market risk, has to be managed after the support periods end, either through a PPA, a certain trading, or other market-based arrangement, which AFRY is very well positioned to, of course, support our clients as they emerge. The carbon and fuel prices remain a critical driver for determining power prices across the region, and so are the renewable imbalance costs, as we just heard from my colleague Philipp. And we see this clearly with markets in Eastern Europe where power exchanges already exist, and cost-reflective power price signals can be clearly observed. So, for example, in Serbia, Croatia, Bulgaria, the new power exchanges, or relatively new since Q1 2016, are providing clear market-based signals for the cost-based sort of electricity pricing, and that with a further, hopefully over the long term, improving liquidity on these markets may lead to additional trading opportunities for managing this merchant renewables risk as well, once the especially support scheme periods are ending. And the especially imbalance costs topic, and in some markets, as Philipp highlighted, Hungary especially, this presents a challenge for investors, and certain regulatory steps in this area being planned and undertaken, also in Hungary, partly in Bulgaria, in Croatia, Ukraine, and so forth. And there is also a certain way through the mitigation steps that we outlined early in the webinar to manage those imbalance costs, or certainly also through additional efficient and high utilization of the cross-border balancing and sharing of reserves, can achieve a net effect of lower imbalance costs. So that can be managed either by the countries themselves on their own, with the TSO and the market participants in the respective markets, or across the regions. And that cross-border approach is something that we see even more consistently, either within the EU or across the energy community contracting parties. The current power systems across Central Southeastern Europe will also need additional flexibility, which will need to account and balance out the intermittency effects of more renewables on the power systems, especially as new build is currently proceeding, despite also the corona backdrop. And that could be achieved by adding some flexible generation, either through gas-fired units or hydropower, potentially where economically and technically feasible. And that flexible generation on the power systems in Eastern Europe is currently in some markets an issue that leads to in some periods higher either power prices, or certainly balancing market provision bottlenecks and essentially higher imbalance costs. Over to you, Matt. Thank you for the Q&A.
Excellent. Thanks very much to Philipp, and Yara. I apologise. First question here: what would be the impact of the EU ETS carbon permits' recent all-time record high prices on resi projects in Central Southeast Europe, also given power generation systems across the region still with a high level of carbon intensity. And I think that picks up quite a number of questions we've had around the carbon side.
Yes, thank you, Matt. I'll take that one first. And I saw in the chat also some questions were being raised exactly in this area. And thank you for raising this point. Let's also see what the final system state for the full year 2020 will be once the verification deadline passes tomorrow, as I mentioned earlier. Especially given that allowances for 2020 carbon emissions have to be surrendered by the compliance deadline on the 30th of April. And only the European Union Emissions Trading Scheme Phase 3 allowances, carbon permits, can be used for the 2020 compliance obligation and period, while current Phase 4 allowances and permits cannot be surrendered to cover the compliance for the previous Phase 3 carbon emissions. So that system state is to what degree, I guess, the system will be long in this case, given the corona impact, will be quite important to monitor. And furthermore, any remaining Phase 3 allowances are still valid thereafter for some period. Additionally, as you know, we are presently analyzing the European Union carbon permits and the emissions trading scheme with AFRY's carbon model called Ether. And a number of key price drivers continue to support the carbon permit prices, including a certainly tighter and tightening, moreover, cap over time, which limits allowances in the coming years. A market stability reserve will see also a certain increasing invalidation and in some invalidation of the allowances, especially starting from, I believe, year 2023 for the previous year as applicable and thereafter. And recently, there has been the confirmed more ambitious EU decarbonisation targets, and that has, you've seen, Matt, and I guess the attendees on the webinar today have seen the immediate impact on carbon prices also increasing further to recent levels of 47, 48, and thereabouts euros per ton of CO2 equivalent, and that's really an all-time high, and that trend will be very interesting to monitor in the coming weeks and months, how that will further develop as that supports to a large degree also the power prices. And an additional factor is the increasing cost of, as I mentioned earlier, I think additional sources of carbon abatement technologies. So all this, when it combines into a, broadly speaking, and let's see how sustainable that is, a higher level of a carbon price, that will likely lead to a more stable and also concurrently relatively comparatively higher power price. And that will certainly push and incentivize more renewables built across the region, even on a purely merchant basis. And that is something that we're seeing also for large 300, 400, 500 megawatt projects on the onshore wind side, especially in some markets that we covered today, as a request from clients to analyze. So this also move to build merchant renewable projects as a concurrently high carbon price supports the electricity prices is something that we're already seeing for a while, maybe a year or two at least, and certainly is likely to continue as long as the carbon price is also holding off at relatively high levels. And one issue is that the liquidity of, as I mentioned earlier, some of the newer power exchanges in Eastern Europe, such as also in Ukraine and also Serbia, Bulgaria, Croatia, and others, would need to further improve to have more depth for additional trading and offtake opportunities. Or some alternatives can be also done with structures like PPAs.
Very good. So good headwind, really. Additional push behind renewable investment with the way carbon prices are developing currently. Next question, where would be the next electricity exchanges emerging and further developing across Central Southeast Europe so that investors can have reliable, transparent, cost-reflective power market price signals?
Yeah, thank you, Matt. I can cover that. Power exchanges are opening up in the region. That is definitely a trend combined with market liberalization. So the next power exchanges are very much likely to be opened up in Albania. So this Alpex plant, together with the Macedonian market, which they are likely to be coupled. There are a couple of discussions going on also with the market coupling with Bulgaria, which is not yet in the 4M market coupling. Another example would be Georgia. There are also intense discussions going on with opening up the Georgian power exchange, as it's also continuing its liberalization trend there. Of course, having a power exchange is not everything. It also needs a fully liberalized market where demand and supply needs to cover its needs on the free market. So there are a couple of examples where a power exchange is in place, but the liberalization is lagging behind, and therefore the power exchange is not fully reflecting what's happening in the market or in the region. But it's definitely a trend that liberalization is ongoing, and also more power exchanges opening up, most of all Albania, Macedonia, and Georgia.
Excellent. Okay, so we'll see some good, hopefully some good reliable price signals from those as time develops. Another question here: what trends exist, and what are the respective drivers regarding electricity price convergence within the target region to date and going forward?
Yeah, thanks, Matt. Maybe I can take this one. And I would say that, yeah, we're already seeing certain signals on the price convergence within the region, and this is what we've already mentioned also on our webinar, and we also see that prices can be expected to converge within the region, and there are certain factors and reasons for that. Of course, the market coupling initiatives, which foster price convergence, of course, through facilitated cross-border trades and also auctioning arrangements for cross-border capacity. One of the prominent examples, and we've already mentioned it, is the 4M market coupling, which involves the coupling of Czech, Slovak, Hungarian, and Romanian day-ahead markets. We also see that the Serbian CPEX is now thinking to couple with 4M, Bulgaria's intention to couple with North Macedonia and Albania. So all of these will further lead to price convergence. Of course, on the other hand, it's the increased interconnection capacities. As we well know, that many interconnection projects are currently underway, and of course this facilitates further price convergence and market integration, especially when these interconnectors are well utilized. I believe one of another important factors is, of course, fuel and carbon price convergence. Fuel contracts rigidity is most likely to be overcome with, of course, more diversified supplier sources, while also another topic, again, carbon pricing, which is likely to be applicable also to contracting parties of the energy community, and this will also lead to convergent price levels, while long-term gas prices may be further determined not only by bilateral contracts, but rather market. And let me finalize with another important driver of the price convergence, which is capacity mix. And here we also have few moments. That is, first of all, of course, the renewables topic, as the increase in renewables penetration will most likely lead to similar price volatility and strong correlation between the countries over the long run. However, on the other hand, it will also may lead to some divergence as well, since, well, depends on the local resources, of course. And we also need to bear in mind that currently there is moving away from coal and lignite-fired generation, and this replacement of these ones by gas-fired units, which most likely will lead to also some similar pricing structures.
Fabulous. Thank you, Yana. And the other speakers, Philip and Philip. I think we are up bang on our time. So I just say thank you to everyone who's joined the webinar. I hope you found that interesting. And it's fascinating how these markets are developing and the opportunities that are getting thrown up. Please do get in touch with us if you want some more information, and we'll try and follow up with as many questions that we haven't answered with you as well. And with that, I just ask the other speakers to say thank you and goodbye as well.
Thank you very much, everyone. Appreciate it to have you on the webinar today. Thank you to all attendees, and thank you, Matt, for hosting this.
Thank you, everyone, for your attention.
Yes, indeed. Thank you also from my side.
Thank you all. Thank you, team.
Bye.
Cheers. Let's close it down there. Thank you.